Imagine turning just $500 a month into nearly $500,000 without chasing risky stocks or complicated strategies. Sounds too good to be true, right? Well, let me show you how it's entirely possible, even in today's market. In this video, I'm not just going to share the usual tips, I'm diving deep into a game-changing strategy that smart investors are using to build wealth steadily, protect their portfolios from market crashes, and keep growing, even when others are panicking. But here's the catch. The key to this strategy isn't flashy, and it's definitely not a get-rich-quick scheme. If you want results, you need to understand how it works and why it's so effective. Because without that knowledge, you might miss out on one of the best opportunities to secure your financial future. By the end of this video, you'll know exactly how to use this approach to not only grow your wealth, but also shield yourself when the markets get shaky. Plus, I'll reveal my personal plan for 2025, including how I'm preparing to invest during this critical time. So stick around, grab a notebook if you need to, and let's simplify investing so you can make smarter financial moves and start building real wealth today. The first and most important principle of investing, which I emphasize repeatedly on this channel, is to thoroughly comprehend what you're putting your money into. Picture this: you claim to be invested in Nvidia, yet you have no idea what the company even does. If that stings a bit, good. Let it be your reality check. Now let's talk about SCHD. It's a fund with low market swings and reliable dividend, offering you an added layer of protection. Think of it as the steady anchor for your portfolio. If your investments include exciting high-risk picks like Palantir, Nvidia, or Tesla, companies that can soar to new heights or tumble dramatically, SCHD works to bring balance and reduce those extremes. A crucial reminder, SCHD is an exchange-traded fund, an ETF, not a single stock. It's not the kind of asset you buy one day and sell the next for quick gains. That's not its purpose. This is a long-term option designed to create stability and consistent growth over time. By putting aside just $500 each month for 20 years, you could accumulate roughly $450,000, even during one of its most challenging periods. Honestly, I feel like the Wolf of Wall Street right now, with everyone urging me to walk away from SCHD, one of my favorite exchange-traded funds, and try something new. But guess what? I'm staying. The mission continues. Let's address the question: why has SCHD been sliding lately? I have a few theories to share. After that, I'll outline my investment strategy for wrapping up 2024 and moving into 2025. Yes, SCHD is down, but it's not alone. Value-focused ETFs as a whole have been underperforming. For example, Vanguard's VTV has dropped 1.42% over the last month. Similarly, another dividend-focused ETF, Vanguard's VYM, has also experienced a decline. As interest rates continue to decline, individuals moving their money out of bonds and high-yield savings accounts will likely explore other options. Many will start by allocating a portion of their funds into something more dynamic, investments that appear to generate endless returns. They'll experiment with growth-focused ETFs or stocks, drawn by the excitement of potential quick gains, even if it's just for a short while. Once these investors secure some earnings from those fast-paced growth funds or companies, they'll keep a close watch. The moment they detect even a slight wobble in the performance of these growth assets, they'll pull their money out. These are cautious individuals who favor security and will feel content with their initial profits. At that point, they'll redirect those earnings into stable, proven investments, assets they view as trustworthy. This is where value-based ETFs and dividend-oriented funds like SCHD come into play, offering consistency and reliability. There are other options, like bonds, savings accounts with reduced yields, or money market accounts, will likely only offer returns around 2%, which isn't exactly appealing or rewarding. There's a method to this chaos, and what I need you to understand is that this is absolutely fine. In fact, it's more than fine if you're a genuine long-term investor. Why is it that when stocks or ETFs rise significantly, people suddenly feel compelled to invest? Nvidia is priced at $100 per share. Nope, I'll pass. but now it's $150 per share. Sure, let me grab some. Oh, SCHD has dropped to $27. No way, I think I'll sell it now. Wait, what? That logic makes no sense. Last month, Forbes summed it up brilliantly in a fantastic article. They pointed out that SCHD is a carefully balanced portfolio of highly rated dividend-paying stocks, paired with an incredibly low expense ratio, making it a standout choice for investors. SCHD has a proven history of delivering double-digit annual returns over the years, keeping it appealing to those with a long-term mindset. Although, of course, previous results don't guarantee future outcomes. Additionally, SCHD shines in terms of dividend growth. Over the last 12 years, it has consistently raised its payouts, achieving a 5-year growth rate of 12%. This is a fund that not only reliably increases its dividends, but has also averaged nearly 12% annual growth in overall value. As an investor, you'd still collect a dividend of 3.5%, meaning your return is 3.5%, not zero. Compare that to a different fund, like a growth-focused ETF, which would leave you with nothing if it didn't grow. 0% means 0%. SCHD is designed to bring stability to your portfolio, balancing out all the exciting, high-risk growth assets you may hold. Its role is to provide protection when those growth investments take a nosedive, because believe me, they will drop. And when they do, it's fast and sharp, not a slow decline. If your portfolio is well diversified, you won't feel the pain as much when those downturns happen. As for me, I'm committed to continuing my dollar cost averaging every single month in 2025, just like I've done throughout 2024 and in previous years. If the price keeps falling, I'll increase my purchases beyond my usual monthly contributions. If it drops below $26, I'll be joyful. Always take the time to understand why you're investing, what you're putting your money into, and the details of each investment you hold. Make it a priority to fully grasp your investment strategy and maintain a balanced portfolio. It's challenging, but absolutely critical. Check out one of these videos to stay inspired and focused on your financial goals. And remember, simplicity is the key to successful investing. Now, here's something to keep in mind. Patience is your greatest ally as an investor. The stock market is a long game, not a quick race. Success doesn't come from chasing trends or reacting to every dip and surge. It comes from staying consistent and keeping your emotions in check. Think about it this way. When markets are down, it's like a clearance sale for investments. That's the time to buy quality assets at a discount and hold on to them for the future. It's not about timing the market, it's about time in the market. Lastly, always review your portfolio regularly. Ask yourself, are my investments aligned with my long-term goals? Do I need to rebalance to stay on track? These small adjustments can make a big difference over time. Your financial future depends on the decisions you make today. So, commit to learning, stay disciplined, and never stop building. The journey to wealth isn't always smooth, but the rewards of staying consistent are worth it. Let's simplify investing, stay focused, and keep pushing towards financial freedom, one step at a time. A quick reminder of SCHD performance over the years. 1. Recent performance of SCHD. Total returns. Over the past 12 months, SCHD has achieved a total return of approximately 12.03%, demonstrating its resilience and consistent performance. Dividend growth. SCHD has a strong track record of dividend growth, with a 5-year compound annual growth rate, CAGR, of 11.23%, reflecting its commitment to providing increasing income to investors. 2. Investment strategies for 2025. Diversified equity strategies. Experts recommend a balanced approach that combines growth and value funds, along with targeted investments in sectors like energy infrastructure, to navigate shifting market dynamics effectively. Barbell strategy in fixed income. With treasury yields normalizing, a barbell strategy that combines floating rate and yield-enhanced funds can help investors balance interest rate volatility and credit exposure. 3. Importance of portfolio balance and regular review. Portfolio resilience. Building a resilient portfolio is crucial, especially in the face of potential market volatility. Regularly reviewing and adjusting your asset allocation can help maintain alignment with your financial goals. Active management opportunities. In 2025, active management strategies may outperform broad index approaches through tactical bond selection and sector rotation, offering potential advantages in a dynamic market environment. 4. Emphasis on long-term investment discipline. Time in the market. Emphasize that successful investing is less about timing the market and more about maintaining a long-term perspective. Consistent investment contributions and patience are key to building wealth over time. Simplicity in investing. Reinforce the idea that keeping investment strategies straightforward and avoiding unnecessary complexity can lead to better outcomes, reducing the likelihood of costly mistakes. Thanks for being part of this financial exploration. Keep an eye out for more videos where we'll dive into these topics and more. Don't forget to like, share, and subscribe for the latest in finance and wealth building. Your journey to financial freedom continues, and I'm excited to be a part of it. Here's to your investing success. Profitable investing.